Welcome to the InterMarket Analysis video update. This is being prepared Thursday, May 12th. And this is a supplemental video that is designed to be in conjunction with the daily video updates that I post every day on the YouTube channel and on Rumble. I would include a part on InterMarket analysis in my daily video updates, but it was getting rather lengthy. And some people didn't like looking at all the charts or didn't feel that they were really useful for them. So I pulled those out. Well, I've had some requests to go ahead and do more intermarket analysis because some investors and traders really use that heavily. So I've decided just to make a separate video. I probably won't make this video every day. I'll just do this 2, 3, 4 times a week. And I'll probably also do it on an as-needed basis. If something develops, then I will go ahead and do a video. What I'd like to start with is just valuation. How is the S&P 500 valued? Now, there are lots of ways to do this. One of the ways that is very popular, and one way to help find valuation, is to try to determine, is the S&P cheap, meaning inexpensive? Is it just about right where it's at, or is it considered expensive? They create a thing called the PE ratio. This is price to earnings ratio. That's ultimately what drives stock prices, or the earnings. And when they're making profits, when a company is growing, their earnings will go up. If they're having trouble, then their earnings will go down. This can also be influenced by the economy, and this changes over a period of time. What you see here is a chart of the S&P 500 in black, and that just takes us up current as of May 11th. And then you see 3 colored lines that are dashed. The red line represents a PE ratio of 20. When it's 20 or above, that is considered to be expensive. When it's at 15, so pretty much anywhere from 11 to 19, the market is just about right, and that is in blue. And when we get to 10 or below, the market is considered to be inexpensive or cheap. Looking over a period of time, you can see that sometimes we get way above these valuation levels and sometimes we fall below them. One thing I do want to point out is what you see on this chart is called TTM. These are based on the trailing 12 months. This is information that's already been filed, it's already public, it's already available to investors. However, the stock market doesn't look at things that way. It doesn't look back. It looks forward. So we have another thing called the forward PE ratio. But that's based on forecasts. That's not necessarily concrete. That changes all the time. Yes, I use that, and it's a very important part of what we do. This way we can look back at something that is more absolute to get an idea of where we are at with things. Currently, we've just come down to the upper end of the range, and we're still considered expensive. We were way above this. You can see all 3 lines, the red, the blue, and the green, they have been climbing. Prices have been climbing a lot more. If you look at the bottom part of this chart, this just measures the distance between price, the black line, and the red line, the PE ratio of 20. And we're coming back down as we're seeing recent weakness in the S&P 500. Here's another chart just to give you some more historical perspective. You can follow the red, green, and blue lines, and we see over on the left-hand side is the 1987 crash, which now just looks like a little blip. But where were we? We were slightly overvalued at that time. After the crash, we came down to being fairly valued. Then we climbed through the 90s, and in about 92 to 93, the market became overvalued. And when that happens, one of 2 things, or a combination of the 2, have to happen. Either earnings need to go up, or stock prices need to come down, or a combination where earnings go up as stock prices may come down to justify those prices. That's kind of what happened back in the mid-90s. Then we got to a point where the market was having a little bit of trouble from 94 to 95. It became more fairly valued at that point. And then we had the whole run up into the late 90s with the dot-com boom and then the eventual bust and then the recovery that happened after that. When we hit the top in 2000, we were very overvalued at that time. Everything turned, went down. We got to a point where things were a little bit better valued, and they came back into conjunction. And this can take a couple of years. These valuation levels are not necessarily something that changes overnight. This is a long period of time. As we were running up from 2003 into 2007, the market was not really expensive, but not really cheap either. Then we had the whole housing crisis, and everything came crashing down. And the number there, the green and the blue and the red, they look kind of crazy because their earnings within the S&P itself actually went negative, and it kind of messed up this chart. After the whole financial meltdown, we started to recover, and we've been pushing up ever since then. We had the post-crisis recovery, and then eventually, back in 2020, we had the COVID plunge, and that really took things lower. We had the bounce, the real V-shaped bounce coming up out of that, and we've been very overvalued ever since that time. And things have been really coming down, and we're just coming down on a historical basis to being back to the expensive level. Even if we drop more from here, the market is still considered to be expensive. Another area that we look at is growth versus value. The top chart is growth. That's in the lead, and you'll see a lot of charts like this in this whole analysis. Then on the bottom, you see value versus growth. And it just shows on the top-hand side where growth has really been underperforming value. On the bottom, it shows how value has been outperforming growth. And I have a lot of different charts to try to represent this. We look at over on the right-hand side where growth, that's when we see the really substantial gains in the markets, or when growth stocks really go up. These are companies like Apple, Microsoft, Amazon, Google, the big boys that really drive the market higher. Into 2022, we've seen a real breakdown in that relationship. Growth has really started to lag behind value on a ratio basis. Here's another chart kind of showing the same thing, but upside down. This is looking at value versus growth. And over on the right-hand side, you can see where value has really been outperforming growth. The S&P 500 value is then compared with the growth ETF, and it just shows that value has been really performing well. The growth index against the value index ratio, and I try to mark up this chart, and if you have any charts that you want me to include, if there's any annotations, any studies that you want me to put on this, I can't really go crazy with that. I can't go into every little nuanced detail. I want to keep this at more of a macro, big picture level, but it just shows that growth really led up from 2020. We had a little bit of trouble back in 2021, but then we were able to recover out of that. We topped out at the end of 2021, and then at the beginning of 2022, we've been seeing a real underperformance. Ever since then, some of the index ratios, here's just the CRB by itself. These are the commodities, and over on the left-hand side, it breaks it down, the kinds of commodities that are being measured. And this can be used as a real good inflation gauge. We have energy, agriculture, precious metals, industrial metals. These things, when they go up, they tend to really inflate the economy. When they're going down, that's when inflation is either under control, if not declining. Well, over on the right-hand side, you can see where the CRB has really been in a strong uptrend. I have a 50 period and a 200 period moving average plotted on there, and we're way above and have been doing very well pretty much since the COVID lows. Here's another representation showing the ratio between the CRB index, commodities, and the S&P 500. Through most of 2012 up into the COVID plunge, the stock market was really outperforming commodities. And that's why you see this really going down. Well, all of that changed into 2021 and has really started to change as we got into 2022. And now commodities are really outperforming the S&P. Here's just an inverse. It just shows the run up of the S&P compared to commodities, but lately that relationship has switched. Here's another index showing the NASDAQ 100. These are the 100 biggest stocks on the NASDAQ, and comparing them with the S&P 500. And it really shows that the NDX, or NASDAQ 100, has really started to underperform. It's not across the whole chart here, but that red line is the 200-day simple moving average, and then I also have a 50-period moving average. And it just shows how The biggest stocks in the NASDAQ have been underperforming the S&P. Some other market ratios that we look at are gold. This is something that people really pay attention to. Gold has really underperformed the S&P. That started to change half or 3/4 of the way through 2020, and we saw gold really going down. And then in 2022, it started to turn up. And right now, gold has been outperforming the S&P. Some other things that we look at are the S&P 100. These are the 100 biggest stocks in the S&P 500. They've been really underperforming the rest of the S&P 500. Then we also have an ETF, which consists of low volatility stocks. These are stocks that, they might still go down if the market goes down, but they usually don't go down as much. And sometimes they might even advance. This is what people like to get into when they're more defensive, when they're more concerned about the market. Well, here's a ratio between the low volatility stocks and the S&P ratio itself. And it just shows for most of the time, the low volatility stocks have really underperformed. Well, into 2022, the low volatility stocks have now been outperforming the rest of the S&P. Looking at bonds, we have interest rates really going up and bond prices really going down. This compares the S&P 500 with the 10-year Treasury yield, and that's a ratio. So this is an interest rate, and it just shows where the S&P has really been underperforming the rise in interest rates. Here we also look at the Dow Jones Corporate Bond Index. Now this isn't a ratio. This is just to give you an idea of corporate bond prices. The U.S. government is not the only game in town that issues bonds. Companies issue bonds as well. They put those bonds together and then have formed an index. And it just shows how as interest rates go up, the value of these bonds have really been going down. Another thing is junk bonds. These are bonds that have a lower rating. And once they get below a certain level, according to the rating agencies, they're considered junk status. You get a better interest rate. And that's what makes them attractive to a lot of folks. But this just measures their price. And junk bond prices tend to follow the stock market. So if the stock market's going down, junk bond prices sometimes they get out of line with each other. But at least for 2022, they pretty much have been following the overall stock market, and they've been declining. Here's a ratio between a junk bond ETF and a bond ETF. And it just shows that even though junk bonds have been underperforming and having some trouble, they are outperforming the price of bonds. And so this is what makes it more enticing to folks. Yeah, they're going to have to take on more risk, and if things really go south, that could lead to more losses. But if you're really looking for a higher interest rate, you're probably going to have to chase after some kind of a junk bond. Looking at some of the sectors, here we have the energy sector, which has just been on fire compared to the S&P. It really underperformed from about 2009 all the way up until after the COVID plunge. Well, into 2021 and then into 2022, we've seen energy prices really going up. And they've been going up a lot faster than the S&P's been going up. Then we also have energy here compared to the technology sector. Energy prices have been rising, but the tech sector, that's usually where the growth comes from. And that's been a good play for a long time. However, things have now changed, and the energy sector is way outperforming the technology sector. This is just the technology sector by itself. And I can easily add other sectors. There are 11 sectors that make up the S&P 500. If you want me to compare any of the other sectors, I can do that. Then we have the technology against the S&P. The S&P has been having trouble, but technology's been having even more trouble. And it's really been underperforming the broader market as a whole. So some other areas are the growth ETF against the 20-year bond ETF. Both of these are really having a lot of trouble, but it just shows that growth is having more trouble right now than bond prices. Here's the 10-year Treasury yield against technology, where interest rates have been going up, so they've been outperforming the tech sector. But for a long time, it was the other way around. Then we also look at staples, and these are things that people have to have, no matter what's happening in the economy. You have to have toothpaste, you have to have toilet paper, those types of things, where there's also a discretionary sector, the things that are nice and kind of make life interesting. when the economy starts having some trouble, they're usually the first things to go. So they're discretionary. In a good, healthy economic environment, discretionary will outperform staples. That's not what we're seeing right now. People are really focusing more on the things that they have to have instead of just the things they want to have. And this also just looks at that same relationship in an inverse way. Discretionary has really been underperforming staples. We look at the tech sector against the 10-year yield. This just shows how for a long time, 2019 all the way up until almost halfway through 2020, the tech sector had really been outperforming interest rates. Well, now that's starting to change and interest rates are going up. Technology has really been going down on a relational basis. Then at the very end, I have just this chart that kind of covers all the different markets. The very top part is oil, and that's been performing the best. Then we drop down a little bit in gold, which had been doing quite well, but the dollar's been strong lately. And so gold has been trailing off where the dollar has been seeing some strength. Then you get down below the zero line, and these things are actually negative. And this just goes back to the beginning of 2022. The black line is just showing how the S&P has been performing. And then the very bottom, the TLT, that is a bond ETF based on the 20-year bonds. Even though they've bounced back lately, they still continue to underperform. So what is our conclusion? And this is taken right from the daily video. Those things that are positive, energy, the CRB, gold, interest rates, and staples, they are positive. What are those things that are negative? And my goodness, this list just goes on and on and on. I'm not going to read all of this to you. And some of this is not necessarily based on what I talk about here. It's also based on what I talk about in the daily video update. But all of these other areas are currently negative. So thank you very much. If you have anything you want to add to this video, any suggestions, anything that I should switch around, please let me know. I'm open to any and all suggestions. Thank you.